What if I told you that the way the government calculates your crypto tax just got completely overhauled, and most Aussie crypto holders have absolutely no idea it's happening? Like they are going to sit down to do their tax return in 2028, open up their spreadsheet, and get absolutely blindsided by a tax bill that's nearly double what they were expecting. That's not me being dramatic. That's what happens when the 50% CGT discount disappears and gets replaced with something called inflation indexation, which is exactly what the 2026 federal budget just announced. Now here's the thing. This change doesn't kick in until 1st July 2027, so you've got time, but only if you understand what's actually changing and why it matters for your crypto specifically. Stick around, because at the 6-minute mark, I'm going to show you a side-by-side comparison of what your tax bill looks like under the old system versus the new one on the same gain. The difference will genuinely surprise you. Let's go. Alright, first things first. Let's make sure we're all on the same page about what indexation actually is, because it sounds like something a boring accountant invented to confuse people. And honestly, they probably did. Here's the dead simple version. Imagine you bought a ute for $50,000. A few years later, you sell it for $80,000. Your gain is $30,000. But, and here's the key, inflation has been running over that same period. The cost of everything has gone up. So your government says, fair enough, mate, we'll adjust what you originally paid for it to account for inflation before we calculate your gain. That's indexation. It adjusts your cost base upward based on how much prices have risen. You only pay tax on your real gain, the growth above inflation. Now here's where it gets interesting for crypto. Under the old system, the one we've had since 1999, if you held any asset for more than 12 months, you just chopped your gain in half. Simple. Done. The government said, congrats on being a long-term investor. Here's a 50% discount. Under the new system starting 1st July 2027, that 50% chop is gone. Instead, your cost base gets nudged upward by CPI, the Consumer Price Index, which is basically the government's measure of how much inflation has eaten into your dollar. So instead of having your gain, you're adjusting it for inflation, which sounds reasonable in theory. But for crypto, it's a very different story, and I'll show you the numbers in a few minutes. Here's a fun fact that most people don't know, and I mean most financial journalists don't even mention this. We've actually done indexation before. Yep. Australia used this exact system for 14 years before the Howard government switched to the 50% discount in 1999. So what Treasurer Chalmers has essentially done is say, you know what, let's go back to how we used to do it. Now, why does that matter to you? Because it means this isn't some untested experiment. We know how indexation works in practice. We know its strengths, and we know its weaknesses. And the big weakness for crypto investors specifically? Crypto grows a lot faster than inflation. Like, a lot faster. Think about it this way. If you bought a bundle of Weet-Bix in 2020 and sold them today, inflation might account for maybe 20–25% of the price increase. Reasonable. But if you bought Bitcoin in 2020, the gain is multiple times your original investment. And inflation accounts for a tiny sliver of that. So the indexation adjustment barely moves the needle on your taxable gain, while the 50% discount would have cut it in half. That's the key insight. And that's why this change hits crypto investors harder than almost any other asset class. Right. Now here's the part of the 2026 budget announcement that's flying completely under the radar in most of the coverage I've seen. And mate, this one matters. It's not just that the 50% discount is being replaced with indexation. There's also a brand new 30% minimum tax on capital gains from 1st July 2027. What does that mean in plain English? It means even if your marginal tax rate is below 30%, say you're retired, or you've had a low income year, or you've timed your disposal to land in a cheaper tax bracket, the ATO will still charge you a minimum of 30% on your crypto gain. Now, for those of you who've been watching this channel for a while, we talked in a previous video about timing your crypto disposals to land in years where your income is lower, to push your gains into a cheaper tax bracket. Smart strategy, completely legal. Well, from July 2027, that strategy is basically neutered. Because no matter how low your income is in any given year, 30% is your floor on crypto gains. That's a big deal, and it's one most commentators are glossing over, so I wanted to make sure you heard it clearly here. Okay, I can feel some of you starting to stress. Take a breath, because the transition rules are actually more generous than I expected, and this is genuinely good news. Here's how it works. Think of your crypto portfolio on 1st July 2027 like a checkpoint in a video game. Everything you've earned up to that checkpoint, saved under the old rules. Everything after? New rules apply. More specifically, for any crypto you already hold before July 2027 and sell after that date, your gain gets split into two parts. Part 1, the gain from when you bought it up to 1st July 2027. That portion is still eligible for the 50% CGT discount under the old rules. Beautiful. Part 2, the gain from 1st July 2027 onwards when you eventually sell. That portion gets taxed under the new indexation system with the 30% minimum tax. To calculate that split, you'll need to know the AUD value of your crypto on 1st July 2027. For major coins like Bitcoin and Ethereum, that's easy. Exchange prices are publicly recorded. Screenshot your portfolio on that date. Save your exchange statements. Export your wallet balances. That single day's records could be worth a lot of money to you down the track. And crypto you buy from 1st July 2027 onwards, new rules only. No 50% discount. Ever. Right. I promised you this at the top. And here it is. Same crypto gain. Old system versus new system. Let's see the actual difference. Let's say you bought $10,000 of Ethereum back in 2024. By July 2029, 5 years later, it's worth $50,000. Your gain is $40,000. You've held for well over 12 months, so the long-term rules apply. Under the old system, your $40,000 gain gets halved to $20,000 after the 50% discount. At a 32% effective tax rate, that's $6,400 in tax. You keep $33,600. Under the new system from July 2027, first, because you bought before July 2027 and the transitional rules apply. Let's say half the gain accrued before July 2027 and half after. So $20,000 is still eligible for the 50% discount. That bit is fine. The other $20,000, the post-July 2027 portion, gets indexed for inflation. Let's say CPI adjusts your cost base up by $1,500 over that period. So your taxable gain on that portion is $1,850. And the 30% minimum tax applies. That's $5,550. Total tax bill, $5,000 on the discounted portion plus $5,550 on the indexed portion. Roughly $10,550 all up, compared to $6,400 under the old system. That's over $4,000 more tax on the same gain from the same investment. And that's a transitional example where half your gain is still under the old rules. For crypto bought after July 2027, it's all under the new system. The gap gets even wider. All right, enough numbers. Let's talk about what you can actually do right now. And I want to be clear, I'm not here to tell you to panic sell your crypto or make any big rush decisions. The legislation hasn't even passed Parliament yet, and some details may still change. But here's what smart crypto investors are doing right now. Step 1. Get your records sorted. Know what you own, when you bought it, and what you paid. If you've been a bit casual about record keeping, and look, no judgment, most of us have been, now is the time to fix that. This is exactly where a tool like Coinly earns its money. Coinly connects to your exchanges and wallets, pulls in your full transaction history, converts everything to AUD at the correct date, and gives you a clean picture of your entire crypto position. You can see all your acquisition dates, your cost bases, your unrealized gains, everything you need to make smart decisions before July 2027. There's a free plan. You can import all your data and see your full summary before paying a cent. The link is in the description, and yes, it's an affiliate link. It supports the channel at no cost to you, and I genuinely use and recommend it. Step 2. Mark 1st July 2027 in your calendar right now. On that date, screenshot your entire portfolio. Export your exchange account statements. Record the AUD price of every single crypto asset you hold. That snapshot is going to be critical for your future tax calculations. Step 3. Get professional advice before making any big moves. If you're sitting on a large unrealized gain and you were planning to sell anyway, it's worth having a conversation with a registered tax agent about your timing. The window before July 2027 is the last period where the full 50% discount applies to your entire gain. That could be significant depending on your situation. Look, this is genuinely one of the biggest changes to hit Australian crypto investors in a long time. And I know tax talk isn't exactly a Friday night at the pub, but understanding this stuff, actually getting your head around it before July 2027, could literally save you thousands of dollars. I'll be covering every update on this as draft legislation gets released. The full detailed breakdown, worked examples, and strategies for minimizing your tax under the new system. So make sure you're subscribed and you've got notifications on, because you do not want to miss those videos. If this video helped you out, smash the like button. It helps more Aussies find this channel, and honestly, it lets me know this kind of content is worth making more of. Drop a comment below. I want to know, are you planning to make any changes to your crypto strategy before July 2027? Holding, selling, completely panicking? All valid answers. I read every comment and I reply to as many as I can. Catch you in the next one. Stay cashed up.